This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This chapter should be fairly well all revision for you. It just looks briefly at what's meant by the term assurance, whether it's assurance of historical information that you would find in financial statements or some sort of assurance maybe about a cash flow forecast. And assurance services are provided because not everyone is able to check stuff for themselves, really. They don't necessarily have the time, they're in the wrong place, they don't have the skills. So what happens is they rely on someone else, like an auditor or an accountant, to do the checking for them and then to produce a report. And as it says on the slide, audit is only one form of assurance, although probably by far the most important one. Types of assurance, we have financial performance like an audit, non-financial performance, we could be asked to report on efficiency measures and effectiveness and economy, value for money type of audit. It could be the physical characteristics of a facility, perhaps the amount of carbon being emitted or the power consumption in a factory, because environmental and social audits are becoming more and more important as people want to, in a way that show that, maybe even to show off their corporate social responsibility type of credentials. Prospective financial information. Prospective means looking into the future, so basically that's budgets and cash flows and the like. Forensic investigations. Perhaps we've discovered a fraud and we want to find out who's done it, for how long has it gone on, how's it been done, how many people have been involved, how much has been lost. And so we have a forensic auditor who will come in and in a way do a bit of detective work. And there can also be assurance about the behaviour of companies in terms of, are they complying with best practice in terms of corporate governance and other regulations. There are 5 elements to any assurance engagement. There is a 3-party arrangement between the practitioner, like the auditor, a responsible party, like the management of a company, the directors of a company who are responsible for preparing the financial statements, and then the intended users, the members. And of course the practitioner is basically reporting to the intended users. There has to be appropriate and well-defined subject matter. So in an audit, it is the financial statements which are being audited, which is the statement of financial position, the statement of profit or loss, the cash flow, the notes to the financial statements, and the movements on reserves. We have to do it to adequate criteria. So we have to apply international standards in auditing, and we're also making sure, and again I emphasize this, that at P7 it is very important to see that the financial statements have been drawn up in line with the accounting standards and financial reporting standards. These set the criteria, if you like, the benchmark for producing true and fair financial statements. There has to be sufficient appropriate evidence, and again I emphasize here that the sufficient appropriate evidence is not just confined to the amount of a figure appearing, let's say, as in the current assets, but has it been properly dealt with according to the relevant accounting standards. And then there's going to be a written assurance in the appropriate form. Very often there aren't any appropriate forms laid down, but of course in auditing there are very, very detailed regulations indeed about precisely how an audit report is to be formulated and what it is to contain. Evidence. The evidence that we need, first of all, auditors must show professional skepticism. Professional skepticism is really walking a tightrope. Professional skepticism doesn't mean going into a client and assuming that everyone is telling lies or everyone is there to try to confuse the auditor. Nor does it go in assuming that everyone is going to tell you the truth. That doesn't mean they are deliberately telling you lies, but auditors have to be aware that everyone is perhaps prone to optimism. In a way you wouldn't be in business if you weren't reasonably optimistic about maybe the sales prospects of a new product. So we're prone to optimism, we're prone to making errors, we're prone maybe to giving an answer quickly without maybe giving it due thought and so on. And of course, sometimes we have to realize that sometimes people are going to deliberately mislead us, but hopefully that is going to be a relatively rare event. But professional skepticism means you don't believe what anyone says without other evidence. That doesn't necessarily mean you believe they're telling lies, but you want other evidence. And once you see something which is at odds, once you see a discrepancy in the evidence, you have to follow it up. Professional skepticism means certainly you don't turn a blind eye. If you see something which is odd, something which is wrong, then what you must do is to, in a way, follow it as far as you can to see the extent of that problem. And you need sufficient, appropriate evidence. Sufficient means enough. Appropriate means evidence, really, that is actually going to help you draw conclusions. It's a kind of quality of evidence. The type of assurance reports that will be given, again at F8, you're almost always asked to produce an audit report, and that is a positive form, or in the positive form. In other words, it is sometimes called a reasonable assurance engagement. In other words, the auditors are required to give reasonable assurance that the financial statements are free of material misstatement. The negative form, this is sometimes called a limited assurance engagement, is sometimes all that would be possible. So it will be impossible really to give a form of positive assurance saying, yes, the budgets are right. Or the budgets are even likely to be right, because budgets are in the hands of the future and so much can go wrong. All you can say is the budgets seem to have been drawn up according to reasonable assumptions, and arithmetically and technically they're correct and so on. That would be a negative form of assurance, saying that there is nothing which causes us to believe that the documents or the whatever we're reporting on is not correct. But that's a long way short of saying we think it is correct. Here we have examples. Positive, the financial trade statements do show a true and fair view. Here we have it's suggesting that the cash flow is correct. Only a fool would say that. You should never be saying that. It's put there just to show you and just to kind of to enable me to strike it out. You could maybe conclude that the appointment of the employee was fair if there was enough information left about the advertising and the interviewing and selection of that employee. We have discovered nothing wrong with the financial statements. Sometimes companies, small companies, ask for something which is slightly short of an audit. They want the financial statements to be reviewed to give them some comfort that they seem to be right. But it's short of an audit. It's cheaper than an audit. And it's quicker than an audit, but it can be useful to them. The basis of the forecast was not unreasonable. Yes, we could say that. We've looked at the trends, we've looked at what the economy is forecast to do, and the forecast looks, it could happen. So it's reasonable. And if we weren't as happy about all the evidence about how someone was employed, we might conclude that there's no evidence that there's been some form of discrimination in their appointment. If sometimes we cannot say that something is right, sometimes we cannot say that we are reasonably confident there are no errors. And a practitioner will not express what's called an unqualified conclusion for either type of insurance engagement, really on two classes of occasion. First of all, if there's a limitation of scope. In other words, we we simply can't find out the information we need. So if you're interviewing people for a job and there are no records left of the interviews, no records left of how we came to the conclusion to award the jobs to a certain person, then we simply cannot come to any conclusion whatsoever. There's been a limitation in scope because the evidence does not exist. The other time when we might not express an unqualified conclusion is if we actually think what we've been asked to give the opinion about is wrong, that the financial statements do not show a true and fair view, or we come to the conclusion, yes, the employment of this person does show evidence of unfairness or discrimination of some sort, then we would not, be willing to give the unqualified conclusion. P7 inevitably is going to give you more scope at dealing with the limited assurance engagements, in other words, in the negative form, that we can't see anything wrong with what's been done, but we're not going to actually say that we're reasonably confident it is correct.